This is something that can get a bit confusing, but if you look at it from the bank's perspective, what's in first position when you buy your home? Meaning, what is most important to the bank? The vehicle that's most important to the bank is of who's most suited for a first position HELOC. Well, again, before we can answer who is most suited for a first position HELOC, we always have to start at the same place. What's the point? What's the goal? Why would you even want a first position HELOC? What is the objective for you to have a first position HELOC? Because if you can't answer that, identifying who is or isn't suitable doesn't even matter, at least from my perspective. So focusing on what's the goal? Are you looking to have more control over your equity, meaning more control over the room between the balance that you owe to the bank and how much your home is actually worth? Are you interested? Do you have a need for having more control? How about flexibility? How flexible is the mortgage that you have today and your ability to be able to access the equity in it to be able to use it for whatever you want? So is flexibility an opportunity for you? Cash flow. Again, if the objective is to fire your job, create your fire moment, create your WTF moment, put yourself in a position to where you can start generating wealth or building income for the future. Is there an opportunity to increase your cash flow? And obviously, debt elimination. The more debt you eliminate from a velocity banking perspective, the more debt you eliminate, the higher your cash flow. The more your cash flow goes up, the more money you have being placed in a position to be able to leverage and do what you want when you're ready. And then the last piece is, well, if we're going to talk about a HELOC as to whether or not it's suitable for you or not, we have to also identify, are we talking about a first position HELOC or a second position HELOC? Now, obviously, on Sunday, when we walked through that example, we were talking about comparing a first position HELOC to a mortgage. We talked very little about a second position. But again, if you step into your favorite neighborhood credit union or bank and ask for a home equity line of credit, they are going to assume that you're referencing a second position HELOC. In some cases, you may have to educate the lender on how or which vehicle you're actually wanting and how they may or may not offer that first position HELOC. So you have to first identify which do you want. And so to kind of talk through which do you want, we have to identify the differences between the two. And this is a slide we've gone over before as well. I'm not expecting you to be able to read it, but the moral of the story is there's some opportunities between the two as far as which one you would want. And I'll highlight a few. Position. What is first position versus second position, number one? And this is something that can get a bit confusing, but if you look at it from the bank's perspective, what's in first position when you buy your home? Meaning, what is most important to the bank? The vehicle that's most important to the bank is the mortgage. So identifying the difference between what's in first position and what's in second, kind of start here. This is the home. If this is your home's value, meaning all of this is what your home is worth, call it 500,000 if you want. And this is the mortgage balance, call that 300,000, then the difference between here and here, meaning the mortgage that you owe compared to the home value, this 300,000, that means you have about $200,000 in equity. So from the bank's perspective, what's in first position? What is most important? The most important vehicle is this mortgage. So in this case, the mortgage is in first position. Well, if you wanted a home equity line of credit in general, then what the what the bank is going to say then is, okay, if you owe $300,000 on this mortgage and you have a home valued at $500,000, if we were going to do let's call it an 80% LTV, 8 times 5 is 40, so 400. So in order for you to get an 80% LTV home equity line of credit, that means that 80% of 500,000 is 400,000. So if we subtract 400,000 from the value of the mortgage, so 400,000 minus the 300 that you owe, the difference is 100,000, which means your equity would be right about here, somewhere around 100,000 in equity is what you would have access to. But what position would that be in? Well, if your mortgage is in first position, that would mean the home equity line of credit for, let's call it 500,000. So if again, this is 300K, this is 500K, Then in second position, this 100,000 between these two. So let's call this 100K. The 100K between these two is what would be in second position. So again, if you've got a mortgage in first position and you are asking for a home equity line of credit, the bank is going to say, how much is the home worth? And if we were to do an 80% value of that home's worth, then the difference between the mortgage and that 80% dollar amount, which would be 400,000, that is the amount of equity that you could have. So that means the home itself is in first position, and the equity, the home equity line of credit that you have is in second. Well, what if you replaced the mortgage with a home equity line of credit? What does that mean? Well, what we're saying is, instead of having a mortgage, what we're going to do is replace the mortgage with a home equity line of credit. Meaning, we're going to pay the mortgage off using a first position home equity line of credit. And when we pay this mortgage off, it's now gone. And so the only thing you owe to the bank is this line of credit. So what's in first position as it relates to from the bank's perspective, meaning if the mortgage is gone, and the first position and the line of credit is left over, then the only thing you owe to the bank, the only I'll call it monthly payment due, is the payment for this home equity line of credit. And in most cases, this is an interest only payment. And what is it about a line of credit? Well, a line of credit is open-ended, meaning you can get money into it and you can get money out of it at the same time. So what happens is you're able to put yourself in a position to where you can pay this off faster. So just getting a first position HELOC compared to a second means a first position HELOC replaces your mortgage, whereas a second position sits behind the mortgage, meaning it's secondary to the mortgage. And then interest rates. Interest rates on a first position HELOC are typically lower compared to a second position. Loan to value ratio. In a lot of cases, the loan to value ratio is very, very similar, but the difference is loan to value ratio on a first position HELOC, you can get a 90% LTV first position home equity line of credit on your home. I have seen 100% LTV lines of credit on home purchases. But typically, the second position HELOC is capped, and it's capped at a lower percentage rate based off the difference between the mortgage and the home value. And then obviously the use of funds is very similar. Both can be used the same way. Tax deductibility on a first position HELOC, no different than you being able to deduct the mortgage interest. You can also deduct the interest coming from your first position HELOC in most cases. And in addition, in a second position HELOC, this is the same. So from a tax deductibility perspective, both of these vehicles kind of function the same. And then from a flexibility perspective, this is where you get the line of credit from matters. Because in theory, the flexibility for both a first or a second position HELOC is the same. But depending on who you get this vehicle from will determine how flexible this second position HELOC will actually be. And here's what I mean. There are companies out there, I think Avon is one of them. Avon will give you a second position line of credit, and they give it to you in the form of a credit card. So it's not necessarily an open-ended product. And so therefore it's not as flexible as it would be had you gotten a second position HELOC that also functions as a checking account or has a banking and routing number. So flexibility kind of dictates how the capabilities you have with that HELOC.